All right, so stocks finished this week on a very strong note. It's strong for most of the week and really finished. A little change in leadership here, very small, but a little bit of change at the end of the week with a strong move to the downside in the dollar. But I'm going to really analyze this leadership that we've had over this past week and see what it's telling us and see how bullish we should be. There's some emerging bullish patterns that suggest we could be bullish now going forward for multiple months. But we got this looming event risk that the VIX won't let us forget about, as well as some other indicators that's suggesting that this movement, as we've seen in the past, may be short-lived. So I'm going to break down those indicators, break down other instances of bullishness with this current leadership during this post-COVID move, and see what our expectations should be. And then our trade idea of the day will be how to trade this bullish trend, but still be aware of the possibility of volatility and still be able to make money from a trade like that. So let's go ahead and get started. Today is Friday, October the 9th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 here with the market forecast indicator. As you can see, we've crossed above the 50th percentile now, so we have a bullish pattern here on the green line on the market on the intermediate line. We're not quite above the market sentiment line, but definitely looks like it's on the path to getting above there, especially with such a strong near-term move here. In fact, this is kind of one big near-term rally. As you can see, the near-term line never did drop below 50 in the last few days. Has really spiked back up into the upper reaches of the upper reversal zone. So which means now that we have, since the 24th, the low of the 24th here, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, which is typically 7 to 12 days, but 11 days in this current near-term rally that we've been on. So nice, good run, as I've shown you in the past. It's been mostly led by a lot of these small cap names as we take a look at like this sector comparison chart here. We just take a look at this 9/24 time frame up until now, and we'll look at like on the 20-minute chart. You can see utilities and real estate higher, but really from this 10/2, so last Friday up until now, you can see that's when it was really a small cap index related rally. So you can, if I will, let me change that to like a 20-minute chart, a 15-minute chart. So that's when energy really has taken off, and some of these other indexes that'll pop up here in just a second. There we go. So now we have energy and utilities and materials and industrials and financials and real estate kind of up there too. And you can see technology and communication services until today had really been lagging behind discretionary, kind of matching healthcare in the markets. So you get the sense that, okay, here's our current leadership, and that's not been our leadership, but that's our current leadership, and how likely and how long do we expect that type of leadership to last? We've seen it in the past, right? We've seen other times where it's been the leadership in the past during brief runs here and even up until here, especially on the Russell 2000. You can see, the periods where it had some really good runs and really good leadership, only to falter. And this one got the intermediate line up above 80. This one spiked up to kind of a parabolic move and got it up to above 80 there. And then, of course, this one got it even higher, the highest out of all the intermediate lines, got us up to about 90 at that point. Strong short-term sentiment as well, as you can see. And then it didn't stay there, and that's where we kind of ran out of gas and turned around. A little different in this regard because we did have somewhat of an intermediate pullback. We didn't quite drop. We dipped a little bit below the 23% retracement, and that was about it before turning back around and heading back up to new highs, even if we haven't yet achieved the pre-COVID high point. The S&P 500 has eclipsed its pre-COVID high and has since also broken through the retracement zone here. So we've rallied up to the retracement zone, we've rallied through the retracement zone, and now we're on the other side of it. And again, getting back above this 78% retracement now means we're headed higher. If you look at the NASDAQ 100, It's a little different. We're actually still in. We had a late push here at the end of the day today. We don't have the green line yet on the moving average. We don't have the dark green shading yet on the intermediate line. And we're not through the retracement zone yet, much less through the 78% retracement. Remember, the Russell 2000 is. The Russell 2000 has not only pulled back up above, but it's also eventually moved up above its old high point that we pulled back down from. So it has moved to new highs, even if it's not to its pre-COVID highs, because it's got a lot of room to make up. As I said before, the Russell 2000 right now is down here relative to where the NASDAQ is right now. So it's still below its pre-COVID highs. For that matter, so is the Dow Jones Industrial Average, though it's also showing a good bullish. All these intermediate lines are below the market sentiment line, so keep that in mind. We're not there yet. A lot of times when you start these new intermediate runs, the market sentiment line's pretty low. Or in this case, you can see, we got up above. By the time we got up above it, that was about it that we had on that divergent high point. I don't think we're going to get a divergent high point this go around, because that move was so parabolic here, especially like on the S&P 500. It was such a parabolic move to get up to that point. It's going to be hard to get a divergent high point with that. So we'll see if that intermediate line crosses eventually above the market sentiment line and then stays above it at such high levels, kind of like this over here after such a long extended run and not very much of a pullback. See, that one briefly dropped below the 23% level too for only 2 days before turning back around. I didn't think we'd hit the 38%, but I did think we'd have a little bit more selling than that, especially considering how high the VIX is. That might be one of the smallest pullbacks that we've ever seen with the VIX up above 25. From a retracement standpoint, right? Only dropping a smidgen below the 23%. Usually, higher VIX will give us, much deeper retracements a lot of times into the retracement zone, because that's the type of market it's expecting, type of move it's expecting. So we'll see if this new kind of emerging posture develops anything more, or if this is another one of those kind of catch-up trades in the Russell 2000 that we've seen in the past that have led to some pretty sharp declines. You can see all three of these led to some sharp declines in the Russell as soon as the intermediate line did get to these levels. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, and you want us to do another video on Monday. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know day in and day out, you can do it with one click right now while you're watching with that thumbs up icon. Also, while you're down there, comment. What did you get out of the video today? What questions or comments do you have? What was the main light bulb moments, or what did you get out of it that was interesting to you? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're checking us out on our blog here, I invite you to check out a couple of things here. In fact, we're going to do a little bit of a giveaway here if you subscribe to our mailing list, which you can do right here down below. Just scroll down below the video down to the bottom. For those who are not watching on our blog, you can find this page by just clicking Market Outlook. There's a sub-menu here, but just click on Market Outlook. It takes you here. But just come down to the bottom, subscribe to our mailing list, sign up for our daily Market Outlook email. And on Friday next week, we'll select one member of our mailing list to receive 1 free month access to our Plus subscription. Our Plus subscription is our monthly subscription. You get access to all of our trading rooms, as well as our Market Outlook live video that you can access here or in the menu up here. So again, we'll draw names out from our mailing list. You can subscribe to right here. You get another entry into that drawing by subscribing to our site. You see up here at the top, this orange line, click the subscribe. You can subscribe to our site for free there. That will get you another entry into that drawing. Again, you have to be entered or subscribed to our mailing list by next Friday. Before next Friday, I'll draw it out on Friday morning. If you're already subscribed to our site and our mailing list, then just click on any link in the emails that you receive from us. whether it's a link to watch the video or a link to any of the links in the video. Just click on any link, and that will also enter you into our drawing. Of course, this drawing is for new subscribers, so any current premium or plus subscribers would be excluded from that drawing. It's just for new subscribers to our services there. Now let's take a look at, go back to the charts, and let's take a look at the weekly chart. So let's look at the market forecast weekly chart. You can see again how high above that 30-week moving average we are. We still haven't tested that yet, but a very strong weekly candle here. So you'll see in the Hakinyashi as well. The intermediate line stayed in the reversal zone. The near-term line has jumped back up out of this lower reversal zone that we had, this oversold level, and of course the momentum line dipping back down. So we'll see if we end up, how much this near-term line continues to move. Now, if you take a look at the Hakinyashi candle here, that's a very, very bullish candle. Obviously, you got a higher high, higher close, no lower shadow. Right? Those are the three things that we look for when we're trending. In this case, you also closed above the prior week's high point, which is a very strong close, and for that matter, the last 2 weeks' highs. So it's a very strong close there. You can see the PPO is turned up, so the gap between the 50 and 200-day moving averages are rising. That 200-day moving average is really kind of moving up here. So we've got a nice little move to the upside. Remember, we haven't gotten above that 78% level yet to where we can say, okay, here we go on a new intermediate run. We're still kind of flirting with that retracement zone, getting up above it here. So we'll see if this translates into more weeks, but we would expect that, right? This expectation on this particular chart is that we continue some bullishness. Now, when you look at some of these other charts, there's a little bit of a question mark here. So the RSI broke above 60 today. The CCI getting up above 100. Not above 200, but up above 100. That's a good sign from a bullish standpoint. But it's just barely up above 60. And we've seen a lot of times where we get above 60 and it can't quite hold that type of move. Or dips below 40 and can't quite hold that move to the downside. So in this particular case, getting above 60 is great, but if it gets above and turns right back down, that would be not so great. Same thing with the CCI, and especially with the DMI. The DMI has really been languishing, the positive index. We're not above 30 yet, and the negative index is barely dipping its toe below 20. So like the RSI dipping above 60, the negative here dipping below 20, that's a little bit of a question mark, right? It's a kind of a turning point where we either just kind of continue this trending, we get going from here, which again, the likelihood, considering the volatility of the election coming up, but we either get going here on a new 1 to 3 month intermediate trend that takes us through the election, so that would mean we're bullish into the election and bullish through the election, or this is kind of a fake out move, whether it's stimulus related, whether especially with the leadership we're having, considering that leadership is not the best, as we've seen in the past. What's happened after that leadership relinquished its control, we typically had some volatility there, at least a 23% retracement. So that's the concern. While the weekly chart suggests, okay, here we go, some of these other charts suggest this might be some kind of fake out type move that doesn't really get us to new highs. It just makes us look more bullish than we actually are, considering the underlying leadership there. If you take a look at the 3 green arrows, we obviously have 3 green arrows. And if you look at the 2 line versions, the MACD, the 8 and 17-day moving averages are crossing over. The MACD's moving average has crossed above 0. The stochastic's moving average is easily above 50 and above 60 here, and not quite in the reversal zone yet. So good, strong momentum. In fact, one of the strongest MACDs that we've had since the original move higher here. When you look at at it from this standpoint, you can see, look at my horizontal line going forward. This is a relatively high MACD considering. Now we are at a higher number. If I were to look at the PPO instead, so let me bring that up here, and then we'll take a look at the 817, which is the equivalent there that we're looking at on the let's just get rid of the MACD and stochastics for now. On the MACD, so here's kind of like a relative MACD. Then you can see, okay, we're not quite as high, But again, these are all really bullish moves, parabolic moves to some extent. So if I were to move this line here to where we're at currently right now, compare it in the past when we were just kind of normally bullish, that is pretty darn high. Here's the 2018 parabolic move. Here's the move off of the Q4, similar to this move here, off the Q4 low point that we had that was so strongly bullish. And then you can see some of these others, the high, strong momentum that we had. So, it doesn't necessarily, even this divergent high point got up about this level. So now the question is, are we going to now this kind of grind higher, or is this one of those type of moves? While we're not forming a divergent high because of this parabolic, finish here that we had, we would be if it wasn't. But we're not forming a divergent high point here. This suggests that this is a pretty strong momentum move, and again, not led higher by our leadership that we'd want to start this type of move with. All right, so when you look at the intraday chart, you can see, look at these gaps that haven't filled. 3 days in a row, we've had gaps that haven't filled. These aren't necessarily runaway gaps. These are just gaps that haven't filled, and we haven't quite finished filling in this one either. It came pretty close. That's where the point of control is now. So we've had, all but 1 day this week, we've opened up with gaps and have only filled the most of one of them. The other 3 are still in them. These are not breakaway gaps, they're not runaway gaps. If anything, this would be considered potentially a runaway gap, though we did fill some of that here, by the end of the week. But again, this idea that we're above the value area, so that's pretty bullish. Kind of a breakout, potential for some kind of like island reversal top here if we were to gap back down and fill in this gap overnight, and then eventually fill in that gap. So another reason why I'm not too sold, again, there's too many gaps. That weren't filled out. I wouldn't feel bad about these gaps if we filled them in during the day and then rallied to close. But we didn't. We stayed up, and closed up higher, especially the last couple of days with very small ranges after the gap. So that means most of this move here occurred on extremely light volume, and even during the regular trading session, it was relatively light volume compared to like a normal session. In fact, if you look at the daily chart and look at the regular volume here, you'll notice, we've had 3 days in a row of very light volume and small ranges, and today's a very small range, even including the gap. So, but that's okay to get grinding moves to the upside, but not with gaps that don't fill right after the open, and then move their way up, right, with regular volume, and not having these overnight moves on extremely light volume hold by the time the U.S. market opens, and then not go anywhere on really light volume during a regular trading session, relatively speaking. The other thing too that I brought up in our technical analysis class today, and again, if you have access to our monthly plus subscription, you get access to this. You can see the S&P, the Bollinger Bands are breaking out through the Keltner channels, and the S&P closed above the Keltner channel today. So very good bullish type breakout pattern right now that's showing up down there. The Russell already got that pattern. Here, let's take a look at the Russell, at the IWM. You can see the Russell already got that pattern a few days ago. Nice little breakout pattern. Again, but we've seen this before. We saw that breakout here above the Keltners, got a good distance above the Keltners. Same thing here and same thing here, and every one of those times led to volatility. So keep that in mind here, that a breakout in the NASDAQ or Russell, at least lately, is not necessarily the greatest sign. The Qs have not had that breakout pattern. So again, this is the leadership, and we haven't seen that type. Now there's some increasing momentum down here, but we haven't had that breakout pattern yet. So keep that in mind too, in terms of how likely we are to continue to break this out. And then finally, if I look at the volatility index, very fascinating volatility index here. Give it a minute to load up. But you can see we're back to here. Let me just go back to the regular chart. We're back to 25, just a little bit under, but you can see with my horizontal line in the past, we hit the same 25 level here. We hit the same 25 level here. This was at the 85% mark. This was below the 85% mark and close to the 80. And then over here, when we were down there, we were below the 80% mark. Right on it or just a little bit below that. So, volatility is down to the bottom of its range right now that we've had for this past month or so, but only on an absolute basis. On a relative basis, it's at the highest level for all these other periods that we've been at the bottom of this range. So it kind of goes to show that even the options market aren't buying into this rally, and potentially might be using this rally to continue to buy protection, in this case at cheaper prices, or relatively cheaper prices on a absolute basis, but you can see still the need for it on a relative basis down here. So to summarize my technical outlook, again, it's I mentioned on Wednesday that this leadership in the Russell 2000 has not been the best, and 2 days later, a little bit of bullishness in technology and discretionary today, but not enough to offset the continued leadership, especially off of last Friday's opening low point, the continued leadership in these small cap sectors, including safe haven sectors like utilities that shouldn't go up in a rising rate environment, that are still going up. So there are some technical patterns that look like we're about to start new bullish trends. And again, a new bullish trend that not only would take us through the election, but through to the election, but through it. And again, how likely the options market doesn't even believe that the markets can maintain a bullish move through to the election, much less through it. Again, especially depending upon the type of outcome, whether or not we actually get an outcome on election night or anytime soon after the election night. So while those bullish patterns exist, that it might be one of those type of fake out type moves, especially with a lot of these other indicators suggesting hinge points where we are as bullish as we can be without starting a new trend to suggest that fake out may be occurring as early as next week, going into, in this case, options expiration for October. So what do you think? Do you agree with that assessment? Do you disagree? Comment down below, especially if you disagree, as to why. What are you seeing that suggests that you are as bullish as maybe some of these indicators says we should be, or are a lot more bearish than I am? They're looking for a lot more of decline for whatever reason. What indicator or chart or macro indicator are you looking at that tells you that? And share that with our viewing community, our Market Outlook viewing community down below. All right, now let's take a look at how our asset classes have performed. Look at that move higher in the small cap index. So again, going to just this last week. So last Friday's open lower up until now, and we'll go to like a 15-minute chart. You can see, small cap stocks have more than doubled the S&P 500 and 7 times the return of the Qs, which for most of this last week, because we started off Friday so bearish and stayed bearish while small caps were bullish, you can see that the move higher. By the end of Thursday, the Qs were still negative. They just had a good run here late, but they were still negative, and IWM was close to 6.5% gain from that open. Big reason why we had today's move, kind of a renewed kind of risk appetite move, was that drop in the dollar. And if I take a look here at the market forecast for the Euro US dollar, which is kind of what we're using to give us an idea of what the dollar's doing, you can see the move back up to that 62% retracement, which is kind of a long-term retracement level, going back to this decline that we had from the beginning of 2018 when I said this bear market started, this kind of fake bear market that we've been in. From an international standpoint, started here in early 2018 and really picked up the pace here in the fall of 2018. So that's a very typical move when you're in a recession. Someone said, I saw something that said the dollar's going to collapse and stocks are going to fall. Well, usually when the dollar collapses like this, that's really bullish for the markets. So I would be very surprised to see a dollar collapse and a strong move lower in equities. If anything, if we get a strong move lower in equities, that means the dollar is breaking down hard. The intermediate line is rising. It's not above the 50 level yet, so we're not out of the woods. We did get a near-term pullback here, and we're starting up to new highs. But you can kind of see that this is an important level that we need to break through. We had a lot of kind of buying and selling up in this 118 and a quarter level, and that's about where we're at right now. So we break through here, and now we're able to get going again. But if not, and we roll back over and retest and potentially come down to 115 and a half to the 38% retracement or up to this 50% line, this one here, then of course that would mean that we're continuing this intermediate pullback that we've been on, that we're kind of getting this fake ending of as of right now, with the small caps leading the way they are. One thing that continues to show a really strong move, renewed move to the upside, is yields. Been flat a couple of days, but on an intraday basis today, we got all the way up to almost 79.9 basis points, almost up to 80 basis points. That's the biggest move that we had. Now, the last time we had this catch-up move in small caps, we got all the way up to 95 basis points. So we've seen big moves on yields here, and there's a lot. The last time we had the catch-up trade, we've seen when small caps have done well, yields have done well too. And you can kind of see too that yields may be done doing well with the move that we've had. So they might be telling us right now that this small cap fueled run may already be over, heading into, like I said, options expiration week next week. Let's take a look at how all the major global economies are doing. So let's just go here to the 12 grid for the 12 biggest economies. And you can see we're back to dark green shading across the board and green lines in some areas, especially these Asian areas, Korea, Japan, India. China is starting to come. China is very linked right now to the U.S. France and UK and Germany are turning around, very similar to the U.S., and so is Canada. Latin America is still really struggling outside of Mexico, and Russia also still struggling. But you can kind of see a good broad base, and I've told you before that South Korea is a very good proxy for global trade, and the fact that it's as bullish as it is a very good sign for risk appetite as a whole. You can see new 52-week highs. In fact, if I were just to go to a regular market forecast here, EWI, you can see new highs here on the index, 52-week highs there. If I take a look at the long-term crossover chart, you can see we just barely got the golden crossover. We're breaking through some of these levels. There's a lot of room to the upside with a new bullish candle. Now, we got a bullish candle there, and that didn't last. So we'll kind of see how this lasts, especially with the PPO already as high as it is, without some kind of first test here of this 200-day moving average, which we haven't really gotten during this quote-unquote intermediate pullback that we've been on since pretty much since the beginning of September. That looks like we may be ending right now. Finally, I want to take a look at commodity prices. Commodity prices have been kind of stuck here too, and still have not produced a golden cross. They've really, since again the beginning of 2018 and then the fall of 2018, when this recession really started, or bear market really started and exacerbated here with the COVID low point, we've really been unable to get going again to the upside and get a golden cross. So kind of watch for that as a lagging indicator, but a confirming indicator that inflation expectations are rising along with yields. Right, that's the other factor here too. Get yields rising, get commodities rising, inflation expectations rising, typically very bullish for risk appetite. I mentioned to you the sector rotation. If I take a look at the 12 grid let's see, is it right here? So we'll take a look at the 12 grid, and here's our market leadership here at the top. Still light green shading at 47 on the intermediate line, and the yellow line on technology. Discretionary has been more bullish than either of his peers, and then you can see communication services still really lagging behind. And you look at a lot of the strength, a lot of the big moves here lately. We got a big move in healthcare, financials. You can see a big move in utilities. Big move in real estate. Again, that's our leadership right now, and not your typical leadership. So not to put too much cold water on this bullish move, but that's the type of bullish move that we've had. And until we get these three up here at the top, which have been the leaders, which you would expect to continue to be the leaders. Let's see, let me bring up the relative strength chart. Here's a QQQ to IWM, and you can see the pullback that we've had during most of this rally has been fueled by the NASDAQ. And there's been plenty of times, as we mentioned, over this past year where the Russell 2000 has made strong moves against the NASDAQ. And every one of these times where the Russell 2000 made strong moves against the NASDAQ, they bounced, but it didn't bounce with everything going up. It bounced with small cap stocks pulling back more than the QQQ stocks have. And this was the one parabolic move on the S&P where we had a rally here with everything going up. So now, we're back to, kind of below this 50-day moving average, potentially rolling back up with the RSI rolling back above 40, the CCI rolling back up as well with a little bit of a divergence there. So there's an expectation we'll continue to move up here. And in the past, when we moved up here, at least initially, it's been with a little risk-off type move. Another reason why there might be some expectation of selling here next week, even if it's early next week. Now, it doesn't mean that we can't be bullish. So for our trade idea of the day, I want to take a look at Procter & Gamble. This is a trade that we actually have on in our class portfolio. It's almost done. But it doesn't mean that we can't be bullish. It just means that we have to be really smart about what we're bullish with and make sure that what we are bullish with has a good margin of safety. So if we do have some weakness here around October expiration into the election, the stocks that we have bull put spreads on don't have a lot of weakness associated with them. And Procter & Gamble is a good example of that. Good bullish chart and a good support level, as you can see on the Bollinger Band charts here. You've got good support from this volume node. It is above the value area, but I think as we get through to November expiration, we'll lose some of this volume here, and you'll start to see this expand out. The point of control potentially will move down to this notch, and then you'll see the value area expand up to include this one. So I think that we'll just be barely up above the value area by the time we get to November expiration, with that volume node helping, as well as the Ichimoku cloud providing some support as well. As you can see here, the Ichimoku cloud will be right around this 140 level, just a little bit below the 140 level. So good support at that point as well, and both its green and blue lines rising in a new emerging trend that doesn't need to be a strong trend, and it doesn't look like it will be a renewed strong trend, but as long as it's not a strong bearish trend, and we can maintain some even over here as it just kind of goes up and down, that's okay, and holds that cloud for some support levels, that's definitely okay. If you look at the long-term view for Procter & Gamble, you can see that 50-day moving average is also there, and that area can also act as a support up here as we've got the strong trend going. And then you look at the 3 green arrow chart, you can also see too, you got the 30-day moving average that will be rolling up now and pulling up with some rising momentum and stochastic. Again, I don't expect that this will get as high as we did over here, but it doesn't have to, right? As long as it stays high, and that's where we come in with our trade in November expiration, selling the 140, buying the 135. That's what the trade looks like here. And notice I only did a couple contracts. This is less than normal of risk because of the earnings that will be coming up before November expiration. You can see it's already gone up a little bit since we got into it during our Market Outlook Live video. Remember, our monthly subscribers get access to that, so you get these trade ideas before the market closes instead of having to wait to watch the Market Outlook video later for them. But we've already moved up higher, and again, this is the idea of just trying to make this 292, and that's what I'm willing to lose out of that 708. Is I'm willing to lose $292. So as of right now, we'd have to go all the way down to about right here, 132. So that would be a pretty significant break to the downside just to get to that point. So that's the kind of trades we like to do these on. Good, strong, good charts, good trends They don't have to be huge directional moves. Otherwise, we'd do a long call vertical or buy a call option. But we've got good support that we can hold up in case of volatility. And that's been a strategy that's worked out very well heading into October expiration, with volatility being as high as it is. And we'll continue to play it, probably continue to play it quite a bit heading into the November expiration as well. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. Our free subscribers get access to that. That's the one forum our free subscribers get access to. Let's keep this conversation going. So open up any new threads with questions or comments you have. Reply to anybody else's threads. It's a community of viewers, so let's just keep this interaction going in between videos here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, as well as the heart on Twitter and Facebook, and comment on our video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.